Welcome back, folks. We got the S&Ps down by 85 points, off 1.2% right now, folks. And to talk about some of the market action, we're going to jump over to our man, Basil Chapman. You can listen to Basil's program, folks, every trading day, 10 a.m. till 11 a.m. Eastern Time, the Tiger Technicians Hour. And if you head on over to the front page at TFNN.com, right in that newsletters tab, you'll see the opening call. You gain access to, of course, Basil's outstanding daily newsletter, folks, okay? Updates every morning. He puts out a weekly video over the weekend, and you gain access to a webinar he just did in December, as well as many others. Check it out on the front page of TFNN under the newsletter tab, and it comes with a 30-day money-back guarantee. Basil Chapman, good afternoon.
Good afternoon, Tommy. How are you?
I'm doing well, man. We got the Patriots coming up in the Super Bowl, Basil, so you got to love that. Boston again. And we had quite a hockey game down here a couple nights ago in Tampa. But, boy, this market, we got some action, Basil. If you could talk to me, the volatility. Quite a 48, 72 hours right now in this market across the board.
500 points down overnight on Sunday going to early Monday morning. 500 points, over 500 points up at the close. This morning we were up 300-something points. We made an all-time high in the Dow at 49,653. And you can see this chart on the left. I drew this in some time ago and saying this area is going to be strong resistance at the 49,600s. And we went right to that level, 49,653, and we dropped back quite sharply. But the real issue is that if you can just step back a little bit, this is the weekly chart in the middle. On the right is the monthly. The monthly, because we've just made a new high. I know it's impossible to believe. I spoke to you about this 2 months ago, 3 months ago, and even 4 months ago. And what I'd said is that the low that was made in the monthly chart in the Dow at 36,661, and this was back at the low of April of this last year, this is still a single leg to the upside, and it's only a leg A. So because it's a monthly chart, because we made a new high, you can't get a peak A until all of March. You have to wait for the very last day of March to be able to confirm that if you haven't made a new higher high in all of March, that will be a peak. So that to me is a very strong sense of the power of, it doesn't tell you how high you can go, but it tells you in the Chapman Wave methodology there should still be a peak A, then a leg B, a peak B, and then a leg C, and a peak C, and then a leg D. That takes you into at least another 5 or 6 months. So it doesn't say, once again, it doesn't say how high you're going to go. You can't extrapolate and say 36,661 to the high of today, 49,653. That's 36,000 to 49,000. We're talking about 13,000. It's amazing. You can't extrapolate and say, oh, we can double that. It just says there will be higher peaks. So that to me is very important. That's number one. But stepping back, the weekly chart keeps hugging this pink 9-period moving, this pink inside track repellent zone. We haven't really broken back up into this pink to green area. That's what I call the repellent zone. Once you break above it, it becomes a propellant zone. But it's just remarkable how, with all that's going on over the last 4 or 5 weeks, look, this is 5 weeks of action, and we are still above the 9-period exponential moving average. So I just wanted to get that aside. So we are still long our core positions in the Dow. But here's what's really fascinating. So we look at patterns, and I showed you a pattern the last week and the week before, and I said it'll be quite something if, let me just put it right there, if the S&P actually goes to a leg D and then maybe a peak D. And look at this. This is from the low that was made. This is just the low that was made back in November, the week of the 21st. We've gone peak A, just a pullback, and then a slightly higher high, leg B, then a peak B, then a leg C, peak C. And last week we made a peak D at 7,002.28. And yet we haven't broken much to the upside. And that's what I'm saying. You see this huge move. You can say, well, we're actually in leg B already in the monthly chart. I can't extrapolate and say, oh, you can double it. I do that, but only after certain conditions are met. So here you are, you've gone from a peak A to a peak D, and you haven't really gone very far, maybe 30, 40 points in the S&P. So you can take time sometimes to make that. So I just wanted to extrapolate. So you had a question?
No, that makes sense. I was looking at that Dow, and so that's the only possible way. That'd be the shortest term way that you could roll from an A to anything else, basically a B, C, D on the Dow, when coming off basically a 14,000 point A leg in the Dow.
I mean, this is beyond comp. 14,000 for one leg. I mean, it's unbelievable. So now look at this. Here's the IWM. So we're also still long the IWM, and that's a slightly different pattern. It's been a leader, but look, now it's struggling a little bit. It hit 267.22. It's taken time. It hasn't broken down very much, but it is taking its time, and the weekly chart is still good. But if you're looking at it in terms of the QQQ, the QQQ is this rectangle formation, and it's kind of stalled and it's pulled back. So I think that the Russell 2000 is still showing better strength. Now, I had mentioned to subscribers, the semiconductors look somewhat vulnerable. Advanced Micro Devices comes out with earnings. But I think the upside is also becoming quite limited, at least in the short term, for the semiconductors. And I want to show you a couple of things. So within the context of the positions that we have, and why I had that webinar a couple of months ago, and I was talking about what we're looking at in terms of this rotation, that the Mag 7, the really great stocks that were just the leaders for so long, they're starting to stall. And look, all of a sudden, what have you got? You got an Alcoa. I mean, a deep cyclical, doing so nicely. So we've been in since the 43s. It hit 66.95 on the 14th of January. It's just stalling here. It's looking, it's really looking pretty good. General Electric, we're still long General Electric, and it's at 308.34. It's down 37 cents here. It's struggling a little bit, but it's still in this category where you've rotated into the deep cyclicals. General Motors, of all stocks, General Motors, I spoke to you about this last week, made an all-time high, 87.31, holding really General Motors. And you read about the average price of a car is something like $48,000 to $50,000. Why would General Motors be at all-time highs? Because I think business-wise, they've done the right thing. And that's really what the stock is saying. So we're still along General Motors. But that was fascinating, and I've been speaking about this for a little while. There's a rotation into, stocks like a Johnson & Johnson, all-time high today. CL is Colgate-Palmolive. A good recovery, a move to the upside. CLX, which is Clorox, doing really nicely off a low. But if you look at the monthly chart, it's not a very good-looking one. But this is the rotation. So we've added Procter & Gamble to this group. I like this very much. It's pushed off the 200-period moving average. The monthly chart doesn't look good, but look how nicely the cup formation is in the weekly chart. So it's very selective. And you and I were talking about this the other day. Well, you've been talking about it for a very long time. But gold, look at gold. I'm anticipating there's going to be what I call the dreaded H pattern. So there's going to be a bounce, and then comes the big test. If it rallies a little higher and then comes back down, if gold at any point starts to pull back below 4,800, then that's the H pattern. I think that's going to stall.
Folks, to read what Basil has to say every morning, great commentary. Check out the opening call and check out that Tiger Technicians Hour. Basil, thanks so much, man. Look forward to the show tomorrow.
Thank you very much, Tommy.
Thank you. We're coming back with Tim Ward, folks. Stay